we go. Awesome, guys. We still have people coming in here, so we'll give it just a few seconds. I'm going to go ahead and put the link for this one in the chat, so if you guys have any questions on that. Yeah, so you guys, we got the whole Elevate team for you guys here in this one. We're actually in Dallas, Texas at Elevate's headquarters.
First time we do one of these with everybody here, so bear with us.
Yep, so just put in a link for this deal right here. So some of you guys may have been on a past webinar, seen our portfolio. All our current investments are on there. So those of you invested with a few of our deals, you'll see, you get your updates through there and where you'll see new offerings. So this is a new one with Sycamore Creek on there. You can create an investor profile. You should only have to do that once. And then on there, you'll see you should see the investor deck. Eventually you'll see your subscription agreement, and that's where you'll get your K1, monthly updates on properties that we have with you guys. K1s, what else?
All the updates.
Yeah, so, yeah, so let me share the screen with you guys. Okay, so Sycamore Creek, it's in San Antonio, Texas, actually just north of San Antonio, Texas, and Schertz, Texas. It's about 15-20 minutes north on your way to Austin, Texas. So San Antonio, if you guys don't know, it's the 7th largest city in the US. I was actually just made aware of that pretty recently. So it's a growing market. As you know, most of you are probably familiar with Austin, Texas, but San Antonio is seeing incredible growth as well. So today we're going to be going over our investment summary, some property details, market overview. Right here, the sponsor team, you guys know us, George and Eric, co-founders of Elevate. Eric sitting behind me, George in the blue. Myself, Justin in the back, and then not pictured here. I guess we get to announce Joel. Yeah, so you guys will be one of the first to know what we're bringing on Joel here as a full-time asset manager. So you've seen us growing with different assets outside of Texas, South Carolina. You recently saw Florida. So Joel has previous experience building out a property management company. We've been talking to him for a while now, and we're really excited to be bringing him on the team. So he's here at the bottom of your screen. Can't really see him, but he'll be in the background of the deals anyways here. So here's our partners on this deal, the Pool Group, Next Base. So they're the ones that actually sourced this deal and brought us on board to help kind of fill in the gaps. They have some assets there in San Antonio, very familiar with the market. So they are our boots on the ground partners for this particular asset. We're really excited to be partnering with this group here. Some of you guys have seen these before. So Elevate does have a strong presence in Texas. We have been looking at San Antonio for some time, and we're excited to be in on this project here in San Antonio. So here's some more of our deals in Houston. So let's get into Sycamore Creek. Off the I-35 corridor in San Antonio, Texas. You'll see we're purchasing it for $153,000 a door. We've got about $2.5 million budgeted for capital improvements. We'll be going through that budget here, and a lot of that you will see is geared towards the interior units. What's really cool about this property is that the past owner owned this property for 18 years. They kept really good care of the exteriors, and it's pretty rare to see an ownership own an asset for that long. So real unique opportunity there. You'll see that more in our business plan. You'll see the loan amount, total equity needed on this one, about $13 million. We'll go more into this loan and some of our debt later on in this project. So I told you a little bit about the property. This is 1984 build, solid Class B property and Class A, Class B neighborhood. 15 minutes, like I said, north of San Antonio in Schertz, Texas. Highly trafficked area, right by a YMCA, right by an A-class high school. You'll actually see some pictures. You can see an Amazon fulfillment center very close to the property. And we'll go more into that too in the marketing plan here. So here you'll see our business plan for that 2.4 million. Part of that, a lot of that for these total interiors. You'll see this top row is your classic vintage apartment. So you'll see that it's not totally worn down or totally, in disarray, but it is that classic feel. So you'll see there with the oven, clear example, outdated. So, we have a strong business plan here to really bring the units to market for that $200 rent premium that we can get with these renovations. So here's some more of the exterior. So fairly well upkept, but again, more outdated. So we're going to bring in this new rebranding, adding a nice touch to the exterior. Pretty easy fixes here, really sprucing up the curb appeal here. You'll see here the exterior plan, upgrade the fitness room, improve some of the landscaping, some new signage like I mentioned, 90 to 100 carports, and some yardage for some of these units. Some simple amenities. So when we're upgrading these units, you do want them to have that more A-class feel. So that these have a real strong return on your investment. So fairly low cost to the return that you're getting on the property feel. So splash pad we have planned, outdoor soccer park, barbecue and cabana area, dog park, very low cost, but we're seeing with more and more pet friendly areas. It's a common amenity that we're adding here.
Can I jump in a little on that?
Yeah, George, jump.
So yeah, this is your typical value add deal, right? We're going in, we've got 100% classic units, haven't been touched. We're gonna come in, make those modern, and then we're gonna drive in more traffic by fixing up the exteriors, rebranding it, putting some real nice signage, painting the exteriors, and then at the same time, adding amenities that are really attractive with the splash pad, the soccer field, the cabanas. And then at the same time, we're also gonna add some other income while we're doing that with the carports, throwing in the valet trash. We're also gonna do washer and dryer hookups in a good portion of the units that we're renovating. So pretty straightforward business plan and easy way for us to add value in a great market.
Yeah, so you'll see some of the breakdown here of the unit mixes with some of those plans for those average 200 a unit bump. Here's some more general information. Class B class building, we're exiting at 4.5 exit cap rate, projecting 3 to 5 year hold. Here's some more photos of these classic interiors. So you'll see, not totally bad shape, but very classic vintage style.
Actually, can you back up there a second, Brian? So wanted to speak on these interiors. When we actually did the due diligence, this property is actually in amazing shape. The current owner has done a very good job. Normally when you're buying B and C assets, you find them to be extremely run down. This is actually one of the nicest properties that we've found in our portfolio that we're going to be adding to our portfolio. That's actually really nice during due diligence. So this is, if you look at these pictures, they're pretty sharp. It just needs to be updated, like Brian mentioned. So that's one thing to point out. Sometimes you walk these assets, a 1984 build, the cabinets are falling apart, and the drywall's beat up, the plumbing's bad, whatever it may be. But these units are in fairly good shape. Even from an exterior walkthrough, it's very good. And then I know we talked about the location a little bit, but this is actually almost in the heart of Schertz, Texas, because like Brian mentioned, you have a YMCA, you have an aquatic center, you also have, it's actually right across the street from Samuel Clemens High School. You know, so it's literally right in the heart of this community, and it's got a very nice community feel. So it's got a very B+ feel to it. And I think once we are done renovating it and putting in all the upgrades, you know, it's going to be a top of the line property in Schertz. So excited about it, and we're going to turn this thing around.
Yeah, like Eric was mentioning here, this location is like we have here, an A location, low crime, great schools. You see that high school that Eric was talking about in the Y right next door. And then in the distance, you can see some of the more anchored employers. So, you know, the Amazon Fulfillment Center, Walmart Distribution, CVS, and then even, you know, New Braunfels, if you're familiar with distribution over them that way. Yeah, so again, on this location, you know, when you want to buy a good asset, but you also want to buy in a good market. So, you know, this Schertz market is positioned perfectly for growth between San Antonio and Austin. Here is a breakdown of San Antonio by sector.
Diverse.
Yeah, pretty diverse. Yeah, you don't see, you know, some of this all healthcare, all military, or, you know, all one area. So, and I think we'll continue to see that diversity, you know, as Texas becomes more and more business friendly, and you're seeing more of that migration from the West Coast and from the Northeast. So you'll see employment rates go, you know, so you get into the numbers. It's great to talk about those employers and the general overview, but if you look at the hard numbers, employment rate is down, population up 7%. That's a big jump for this market. You can see again how I mentioned Texas and Florida, you know, high net migration to these areas. Here's some of the rent studies that we did on the property, checking out comps. We'll go more into that too. Here's another breakdown of this economic job drivers. Amazon, Medical Center, Hulu has a presence there, FedEx, and obviously Randolph Air Force Base. So here we're looking at the comps. Spring at Live Oaks. Right here you can see Class A minus, they're getting about over 30 cents a door, over 30 cents a square foot higher than what we have projected for our post renovation. So really we're going to be pushing for that. But in our underwriting model, we have this 970 for projection. Here's some more comps. Again, you can see, you know, we want to be concerned. It's one thing just to say we're going to get $200 a door or $300 a door, but we want to really drill down these comps when we're looking at these properties. So we've got 4 properties right here that we're looking at comparing to. Financial analysts, we'll get into here. So current T12 numbers, just over 2.3 million on gross potential rent currently. The first 6 months, we actually have that at 1.1. And then we're going to be jumping that back up to 2.9 and a steady increase from there. You can see right here, we actually have those rent growth 3 to 5%. And then here you'll see compensation. So the limited partner ownership on this one, we had a pretty unique split, I would say. If you, George or Eric, you guys want to attest to that?
We decided to, you know, we're really de-risking this deal by going in with low leverage, somewhere between 60 and 65%. It's going to be lower than 65%. And what we're doing for our investors is we're doing a 6% pref, and then us as GPs are not gonna get a dime until you as an investor reach a 15% IRR. So, and then it's gonna go from there to a 50-50. And you can see some of the returns, you know, that's gonna give you, projected off of a 5 year, it's gonna give you a 102% return, a little bit over two equity multiple, and then average cash on cash of somewhere between 7 and 10%. So very attractive. You know, we de-risked the deal with where we are in the market right now and the interest rates by going with a little leverage, and then giving a very generous split to our investors.
Yeah. So again, that's 100% cash flow upside to the investor until we get to that 15% IRR. So that is just another level of, you know, comfort to you guys as investors before we make that split. And us as managing and general partners, it's even more incentivizing us to perform on this property before we start getting compensated on that. Here's your investment example for your $100,000 split. If you were to invest, so for every $100,000, here's what that would look like year by year, based off our projections. Again, we have that 6% pref, so you guys are paid 6% on your cash on cash before this split. Sources and uses, again, we mentioned 60, I think it's going to be about 62% on our debt. Investor benefits, cash flow, profits, you know, obviously tax benefits on this one. We have that right here, 86% depreciation is what we are projecting for year one. Here's another general overview.
I think it's good to mention that us as GPs, we're going to be putting in right around 1.4 million. So, you know, we're investing side by side with you guys on this deal quite a bit.
Yeah, we're excited about this one. Excited to be, you know, we definitely invest alongside every deal, and you know, the 1.4 is definitely a sizable amount. So we like having, you know, skin in the game, some would call it, and you know, we're definitely vested in this one. I'm going to leave it up for some question and answer for you guys. Anything you might have for us that we didn't cover, if you thought maybe I skimmed over. So we are under contract right now, just passing some of our due diligence periods. So we are now taking soft commits and funding. So thanks to those of you that already has made some of your reservations once we sent that out this morning. So, you know, as you'll see, you know, there's more and more capital going after real estate after it's shown in COVID and pre-COVID and the way the inflation is going right now. So if you're comfortable with the deal, we definitely encourage you to make a commit sooner than later. But at the same time, we definitely want you to be comfortable with your decision. So reach out to myself. If you have any questions at all about any part of the deal that you're unfamiliar with or how the process works, I'll be happy to answer you guys. I'm just Brian at elevatecig.com.
Yeah, looks like we got a couple questions there, Brian.
Yeah, this is Raul. Is this only for accredited investors? So this is a 506c. So you'll see anytime we put something on our social media, that's a pretty good indicator that it's going to be a 506c. So we're able to advertise that and show that to investors. So you will have to be accredited on this one. So $200,000 of income the past 2 years, $300,000 of joint income for the past 2 years, or a net worth of $1 million. Moses, yeah, no problem, Ro. Moses, you lock in your debt rate already. What is your debt DSCR? That's a good question.
Or upon stabilization.
Is that upon stabilization, Moses? The DSCR. Our rate going in, I think we had that, you guys know off the top of your head?
No.
He's asking if you have a pitch right there.
What was that?
He's asking for 1.3.
Yeah, that'd be easy. And maybe in the pro forma.
We do have a weekly call with our lender, with the GP group. So here it is, 1.32 DCR. I'm not sure about the.
Yeah, debt coverage ratio end of year one.
Yep. So
Just us out with us.
yeah,
Typo there on the presentation, but yeah, debt service coverage ratio 1.32.
right there for you. And then as far as the interest rate goes, we are buying a cap on our interest rate on this one, I believe.
Yep.
Yep. We are buying the interest rate cap.
Yeah, and that's something we do on all of our deals, you know, because with interest rates rising, you know, we can expose ourselves to a lot of risk. So as soon as we close, we buy an interest rate cap.
So 3.9.
3.9% right here. Rami, where are you spending most of the CapEx budget? For example, the cabinets look in great shape. Are you replacing them?
We're replacing the cabinet fronts, so not the actual boxes. And then all new fixtures, all new appliances. I mean, you can see the difference there. We're putting in quartz for the countertops.
Yeah, you'll see right here. So
Flooring.
not here's our budget per unit. So we're at 200 units total. So the studios, we have about 9,000 per unit, 1 bedroom 10,500, and two bedroom 14,000. And like you mentioned, and Eric mentioned too, you know, they are in great shape. You know, just kind of updating the, like you said, George.
The cabinet
Very
fronts.
modern. Yeah.
Yeah.
Yeah, to his point, I mean, yeah, you look at the pictures and you think, wow, this is in great shape. It doesn't really need much, right? But in order for us to get these rents, we have to, you know, upgrade it to a certain level, which is based on what the comparables are showing us, right? So that's why we're replacing cabinet fronts, doing quartz countertops, replacing appliances, making them a little bit nicer than, like, for example, your typical C-Class, right? If this was C-Class, we would just simply be painting the cabinets, putting on new hardware, resurfacing countertops, changing out light fixtures, that type of thing. But this is a little bit nicer of a product in a nicer area because it's a B plus, you know, area. So that's the reason for the nicer finish out. But yeah, we agree. I mean, the units are in absolutely great condition. And I mean, if we decided to just do a simple unit turn, they're probably going to be easier than most.
Going in at 6.5. I saw that.
Yeah, that 6.5 was, I think a cat, what was that? Stabilization. So that's where we're at stabilization. I couldn't tell you the exact, let me see here. We have that somewhere. But yeah, the purchase.
It's a low 3, but we could.
Yeah, it should be low 3. Yeah, the 6.5 is what we have projected for stabilized. I would say probably around 3 going in, and then.
Yeah, I think somebody asked purchase price, so it's $153,000 a unit. So purchase price is $30,750,000.
Yep.
There it is.
Here you go. Good question, Dan.
Hey, Dan.
Dan, are you renovating the units upon turnover? Yep, that's exactly right. You know, as they become vacant, we will be turning them over to these modern units.
Yeah, when it comes to value add, I mean, the goal for us is to increase the rent as soon as possible, right? So if somebody vacates a unit, the renovations start, you know, immediately. Obviously, we have to, you know, on weekly asset management calls, we have to basically mitigate and how many units we're going to be turning at you know, a certain time, so we don't expose ourselves too much with vacancy. But you know, that's something that we do and manage on a weekly basis. But for the most part, yeah, the goal would be to renovate all the vacant units first, and then as they turn as people don't renew or whatnot, or we don't renew, we start the value add renovations.
Going in cap is 3.5.
And then
That's better than a 3, so.
what is the renovation timeline for completion? So, you know, with these being, you know, fairly full, I would say, you guys have a good.
Yeah, so I mean, the exterior upgrades and the rebrands, all that stuff will get done in the first 6 to 9 months max. And then the interior units are gonna take more like 14 to 18 months, waiting on a turnover, maybe even 24 months.
Yeah, and you'll see that. And so we have that refi event happening at the end of year 2. So 2024, you'll see that where we'll, you know, once we have fully gone through the complete renovation of all these units, that's when we'll really be able to pull out that equity for you guys. Karen asks, is return to investors paid from rent increase or mixed with refinance after a certain period? Secondly, how in US is it works in terms of things go south, investors will have first right on the asset resale or something different? So first part of that question, return to investors is paid from rent increase or mixed with refinance. So it's a mix of both. You are getting paid for the cash flow throughout the life of the investment, as well as a refinance and sale. Secondly, how in the US, if things go south, you know, where you have first right on it. So we mentioned that in our structure, it's pretty unique. So the investors do have 100% of the upside until that 15% IRR of cash flow.
Yeah, with the leverage we have, I mean, the world would almost have to be coming to an end for it to go south at, you know, 62% leverage.
Yeah. So we are super conservative on this with the debt service ratio and the leverage and the structure of the deal. You know, besides that, you know, if the U.S. Air Force decided to pull out, the Amazon fulfillment center decided to pull out, all these employees started to come out of the area, you know, the lender would be the first right on there, and then it would go to us. But as George mentioned, we're very well insulated from those events. When is distribution monthly? We typically do quarterly distributions. So we'll do quarterly distributions usually we'll wait for the first 2 quarters to see how the property is performing and meeting expectations, and then from there we do quarterly. We are looking at doing monthly distributions. It does cost more on the upside or front end, a little bit extra work, but that is something that we're looking at to see if we can bring that to scale to you guys. But I would plan on quarterly distributions. What's current occupancy? How long will it take to renovate? So we answered that second question, how long will it take to renovate?
14 to 18.
Yeah, 14 to 18.
And I believe the occupancy is 96.
96 current occupancy, yeah. So the community, so we mentioned it before, this owner has owned it for 18 years, and it actually has a really good reputation in the Schertz, Texas area. So this is a unique property. In that sense, we will actually be keeping the property management company that is currently managing it there. So we will be overseeing them with our own asset management team to make sure they meet expectations. But we were really impressed, one, with their presence in the community, with how they were perceived in the community. We had a paver go over there to give us a contracting budget, and he was saying how well the property was perceived. So we do plan.
My whole construction team, that
Yeah.
went out to do due diligence, they all called me to, you know, they've been to all of our sites and a lot of properties in general, but they specifically called me on this one to tell me what good looking property it was.
Yeah, so you see that just in the occupancy numbers too. That's part of it, and also, you know, we touched on the market as well. So minimum investment on this one is $100,000. Thank you, Karen. Yeah, if you guys have any more questions, feel free to reach out. Yes, Bob, is it going to be bonus depreciation on first year? So first year, we will be doing bonus depreciation, cost segregation. You'll be seeing 86%, 84 to 86%, I believe, on that.
Yeah, 86.
86%. Distribution started at month 6.
Likely, yes. Usually we start distribution 6 months to a year. You know, obviously the sooner the better, but you know, think about it. When we're buying properties, we have to start the value add. We're going to have a time where, you know, we're going to have some vacancy, but you know, normally distributions do start after 6 months. And then that's all processed through our syndication portal. For those of you that have invested with us before, everything is handled through there. We do distributions either via ACH or via check, via syndication program. It's all kind of a one-stop shop, so you can get all your information there.
Yeah, I'll put that portal again here for you guys. And then I will also put I'm gonna put this link for you guys right here in the chat. Make sure that went through.
Yeah.
You guys can actually, if you go to the portal, to that link, you can download the slides. You have to log in to be able to download it.
Yep. Yeah. So Harry, that deck will be right there in that portal. So you'll be able to get that in there and download the portal, that investor deck.
Yeah, you have to sign up as a new user, and then once you go to the open investment, it'll be there.
The whole time for your past projects in Texas. You know, our average hold time has been somewhere in the 2 to 3 year range. You know, we're still projecting off of 5 years, but when we just exited out of one that literally on the 1 year mark. So I mean, it just depends. We're always gauging the market and seeing the best time to sell for our investors.
Yeah. Past projects, yeah, 3 years or less. But we are projecting 5 years. So be prepared to hold for 5 years, but it could be less. You know, if we see an opportunity in the market, you know, our goal is to, you know, get double your equity and get as close to that. And if we see an opportunity to do that earlier, or we can pull that out and give it to you where you can reinvest, we may look at that if we're able to implement our business plan longer. Management fees, such as asset management. So we have a 1% asset management fee.
Management fee will normally be 3%.
Yeah, and the on-site property management and leasing, maintenance, overseeing, they get a 3%, and then our asset manager for group will be getting a 1% asset management fee. How about K1s? Are you operating this or sponsoring this, or will we have to wait for K? Yeah, so K1s, we will get between, K1s will come to you between March and April. So that'll also be uploaded to you guys to your investor portal. We will be sending those to you. So we do have a lot of people that either invest in their personal name, their business name, and their Roth IRA, 401k accounts. Those are all accepted. And we do the K1s just the same for each of those. What's the projected occupancy rate during renovation? The initial 14 to 18 months. It's a good question. Let me get that. I think I have an idea. I want to get you the exact numbers right here. So here's our projected operations right here. So for the first 6 months, you'll actually see that we are, you know, have a lower gross potential rent to account for those renovation.
You can see how the vacancy's higher, it continues to trickle down.
Yeah, we have vacancy loss, other economic loss, 9 to 15% budgeted for this, just to account for any market corrections. As we talked about, there's about 4% vacancy right now.
This is about 50%.
Yeah, typically we'll be somewhere in the 80s when we're doing renovations, but that's expected, you know, and then once the renovations are done and we fill those units, it goes back up relatively quickly.
With inflation, Harry, with inflation up, have you factored in increased cost of materials?
Absolutely. Cost of materials go up every day.
Yeah, so we've been able to, we have a lot of volume of work that we do, and we're able to leverage that and keep it as low as we can. We also for supply chain issues, we'll order a lot of these materials up front. We'll keep them on storage on site. We've been able to manage all our other projects and keep them within budget for the most part.
Yeah, that's a good point. It's nice having J&T Construction in-house. So they're doing construction every day on this exact asset class. So we have a really good gauge on the market for materials and labor costs. So, you know, we can be super accurate and conservative in our underwriting on that. And we definitely factor that in, even though we are able to leverage J&T's presence in the construction industry and get those sort of, you know, economies of scale.
So our last offering, I don't know if you guys saw that, one in Jacksonville, was fully subscribed in 1 week. So, you know, I would just say if you guys are interested, definitely do your homework, but then also, you know, don't hesitate to take action because our offerings are going by pretty fast.
Yeah, absolutely. Yeah, so we definitely appreciate everyone's time. We will send a link out, so make sure you guys are signed up for our email updates. We will, if you are on this webinar, you probably got our email update, and if you're not, you can go to elevatecig.com and get on there. We will send the webinar recording link. And we look forward to investing alongside you guys in another great project here. So really appreciate your guys' time and hope to be talking to each one of you guys here soon.
Thank you.